In the world of smart money trading, the concept of inducement and price inefficiency, which is imbalance, plays a vital role. Have you been in a situation where you have multiple points of interest and you don't know the particular one to trade from? Yes, it happens in the market where you have a lot of other blocks to trade from, and at this point you're confused to do this. If you understand the concept of inducement and price inefficiency or imbalance, I tell you that you can approach the market when you have multiple areas and you will be able to select the particular one to trade from. This is what I'm going to cover in this particular lesson. I'm going to focus on two main concepts: price inefficiency and inducement. So if you're interested in learning smart money concepts, kindly hit the like button, and you can as well subscribe to this channel for contents like this. Let's jump straight into the content of the lesson. Let's start with this sketch. Looking at this particular sketch right here, if you are asked to select the point of interest you're going to trade from, you see some traders coming to select the particular one we have right here. You see some other traders coming to select the one we have at this particular low, and you see other ones coming to select another one at this particular area. So this means that we have multiple points of interest right here, and at this point you'll be confused on the particular one to trade from. When you understand the concept of inducement and imbalance, you can be able to select the right zone in this particular area. Now, I guess you understand what price imbalance means. Price imbalance is simply the inefficiency between buyers and sellers in the markets. And I've had lessons where I talk about price inefficiency, so I'm going to link them in the description, okay? Price inefficiency is the same as imbalance. Some actually call it fair value gaps. You need to have the general understanding of what it means in the market and how it's created. Not only understanding what it means, but you need to understand how it's created in the market, the psychology behind the creation of price inefficiency. But keep calm, I will still touch it as we progress in this lesson. But if you want to have the general understanding, have a solid foundation about price inefficiency or price imbalance, I'm going to link the lesson in description. Now, when you understand price imbalance, another thing you need to understand is what we call inducement. It could be called liquidity as well, but in this case liquidity is actually a very clear one. When you see a liquidity area in the market, it's actually very easy to identify compared to inducement, because liquidity areas, a lot of people know them as double tops, double bottoms and stuff like that. But when it comes to inducement, it may actually be a particular low or a particular level, which is a trap, because inducement is traps in the market. Trying to explain inducement in my own understanding, I can say that inducement refers to the deliberate creation of false signals by smart money. Inducements are traps in the markets. Now, when you take the positions, you are being trapped at the wrong side of the market, then smart money themselves moves to the correct area of the market. So I'm going to explain all these concepts in this lesson, so I guess you don't have to skip this lesson, because you're going to learn a lot before the end of this lesson. Now, looking at this particular price action, looking at the sketch we have right now, I said you have to combine the concept of inducement and price inefficiency to understand this. Now, looking at this, you're going to understand something. At first, I'm going to say that this particular zone right here is actually not the zone we're going to pay attention to, okay? We're not going to pay attention to that. Instead, you're going to look to trade from this particular zone. It's better you pay attention to the zone we have at this particular high, okay? The one we have at this high is better than the one we have at this low. So I'm going to delete this, or okay, I can go ahead and label it with a red color, so you know that this is actually an inducement area. This is actually a trap in this case. Why do we see this particular level as the correct zone? If you look right here, we have what we call a shift in market structure. And when we have a market structure shift in the market, this is a sign of reversal, which means that you're possibly going to have a reversal in trade in this particular case, because you can clearly see that price breaks structure to the upside. We have this reversal to the downside, and you see this little accumulation right here is actually a sign of weakness, and you see price has been trending up. Now you've seen this sign of weakness, it signifies that we're going to have a reversal to the downside. And what confirms this reversal? This market structure shift you have right now. So since we have this market structure shift, it confirms the sign of reversal. Then this area right here is a smart money trap. Don't look to trade from there, because this zone right here could possibly hold price, because we have confluence that has confirmed to us that we're going to have a sign of reversal. What are they? We have a break of structure, sign of weakness, a market structure shift, and now we have a very good order block right here. So this indicates that this is a failed zone. Now when we try to measure with our Fibonacci tool from this low to this particular high, you can clearly see again that this particular zone right here is at a premium level, and we usually sell from the premium level. So looking to buy from the premium level currently means that this particular zone is actually not the correct zone to trade. Since you sell from the premium level, you see it has increased the probability of this particular zone playing out. Now back to the concept of imbalance. Now imbalance is price inefficiency between buyers and sellers. Now when we talk about imbalance in the market, you can clearly see from this particular area price expand rapidly to the upside, leaving this zone right here. Currently we have an order block right here, and a lot of people will be paying attention to trade from this particular order block. Now have it in mind that we equally have another imbalance right here. When we go to a price chart, you're going to see that, okay, I think we should go to the price chart now to explain this, so it will be a little bit better and you understand better. So like I was explaining, this particular zone will be labeled with the red color, so you understand that it's actually an inducement trap. Just like I said, the right zone to trade from currently is this particular one right here if you're looking to go short in the market, because we're having this price action right here, which is a sign of weakness. At first we have the break of this high before the reversal to the downside. So this break of this high, I can actually call this a liquidity sweep, because price takes the liquidity at this particular high and you see how it reverses immediately to the downside, giving us a market structure shift. So when we had the market structure shifts, it confirms the sign of reversal. So this indicates that this particular zone we have right here is an inducement area. It's not going to hold price. Now where we have our attention is at this particular low right here. Now when we talk about how order blocks are being created, I usually teach, and other mentors who you do watch here on YouTube usually teach, that an order block is formed after we have maybe a pivot to the downside, that is price reacting to the downside, then a massive reaction to the upside, that is price expanding out of a range. Now you see this bearish candle right here, they're going to tell you that is another block. Yes, this is another block. All the other blocks you see in the market is not going to hold price. You see this particular order block we have right here, this is actually a trap in this particular example. It's not going to hold price. Why is this order block not going to hold price? Yes, we have price inefficiency right here. Price left an imbalance. You see this gap right here, this is an imbalance, and when we have an imbalance in the market, price usually gravitates back to these areas of imbalance to mitigate that. And you see at this particular low right here, we have another imbalance. Now this particular zone we have right here, even if you decide to mark the whole range, because we call it have a range created demand level right here, if you decide to mark it this way. So if you decide to mark it this way, you're going to see that this is actually a range created demand level. This demand level is not still going to hold price because it's an inducement trap. Now what makes this an inducement trap? You see we have another zone at this particular low, and this zone has price inefficiency. So you having price inefficiency underneath this particular low, this automatically confirms this area as an inducement area, because how price reacts, it's price draws to area of inducement. The two areas price draw to in the market is basically area of inducement or areas of imbalance. And what is price going to these areas to do? Price usually gravitate back to these areas to sweep liquidity or to rebalance price inefficiency. Now if you look right here, we have price inefficiency at the low. Now this zone automatically turns into a smart money trap. Now having price inefficiency underneath this low and having a lot of smart money traders looking to trade from this particular level right here, you see this automatically makes this a smart money trap. A lot of money is resting at this particular low. A lot of smart money traders are looking to enter their full position on this particular level. Now having their full position on this particular level makes it a liquidity area, because liquidity is resting underneath these lows, and a lot of stop loss is here. People looking to buy from this level to the upside, because yes, this particular zone is at the discount level. You see momentum entered the market after this range. Now they're going to look to trade from here, but agree with me that the correct zone to trade from right now is actually these two levels we have right here, the demand level we have at this low and the one we have at this particular high. Now why are we looking to trade from these two levels? This particular one right here, you see it equally have price inefficiency before momentum kicked into the market. Now the one we have at this low, yes, I'm marking the wick right here, and if you understand the fractal nature of the markets, if you drop to a lower time frame, you're going to see that we have another block inside this wick. Let's drop to the lower time frame. Now this is the 15 minutes time frame, and on the 15 minutes time frame you can clearly see that we have an order block right here. And let's go back to the 1 hour time frame, because we are playing on the 1 hour time frame. So you can agree with me now that it's a valid zone because we have another block when you drop to the lower time frame. Now, what makes this a more high probability trading opportunity? Now you can clearly see that we have a liquidity sweep. Price takes the liquidity underneath this low. And if you understand how pricing efficiencies is created in the market, the liquidity sweep right here occurred when the institutions was trying to push retail traders at the wrong side of the market. Smart money moved with momentum to the upside. You see this particular candle that creates this pricing efficiency. This is institutional footprints in the markets. After that, they slowed down a little, and after they slowed down a little, they added more positions which pushed price to the upside. They have a lot of orders at this particular area because you see at first they sold to buy, right? They sold to buy. Now it means that their sell position is still open when they bought price and moved with momentum to the upside. Now the expectation is that they're going to retrace back into this level because they're not going to close in losses. They have to push price back inside this particular area to mitigate the orders. And what is mitigation? Mitigation is reduction of risk, where institution is going to come back to this position, that is pushing price back into this level just to close their sell position, and that's when they're going to look to enter their full position to push price to the upside. So this is why I'm telling you, you have to understand how imbalance is being created in the market. The pricing efficiency right here was created when institutions moved with aggression to the downside, takes the liquidity at this low, and you see them moving with momentum to the upside. Slowing down at this particular area is then building an inducement because they know that a lot of smart money traders is going to fall for this trap. And the thing is, sometimes you might see me fall for this trap as well because you can't know everything in the markets. But all you need in order to avoid this kind of traps is when you pay full attention to the market, you usually come to the price chart to read what price is doing in the market. So with experience, you can actually avoid this kind of trap. This particular trade opportunity, the low right here, was actually shared to those in our VIP, and let me show you. So this is AUDJPY, the 1 hour time frame. So this is the setup, what it looks like when we shared it to our VIP community. You see, marking this area as the inducement area, that particular zone that was created as the inducement area, and selecting the extreme level. But in this case, I didn't refine my zone down to that lower order block. I looked to add the full order block when I dropped to the 30 minutes time frame. Now what we're going to do is we're going to play price for to see how price reacts to these price levels. Now at first you see price moves to the upside, mitigates the supply level, even though we have little spike above the high. Price mitigates that and we have little reaction to the downside. I believe no reasonable smart money trader is going to look to trade from this particular level. Where a lot of people might actually fall for is this particular one we have right here, this inducement area. So let's continue to play price forward and see how price reverse with momentum to the downside, and it blasts through this inducement area. But at first, what you're going to notice is that when price came to this level, we had little reaction. You see, we have little reaction to the upside, and a lot of people might actually think they are making little profit from here. Now price reverse massively to the downside, mitigates this level, and we having that reaction to the upside. Now you see price reverse to the upside from that particular area. You see how massive the move was. Price moves to the upside and it was able to take the external range liquidity. Now what I made from this particular setup was actually 4%. Let me show you. So this is it right here after price hits our take profit. So I was able to make 4% from this particular trade when price hits my target, and I made 4% because I marked the whole of this range. If I was able to refine to this down candle, that is the 15 minutes order block, I would have made more than 4%. I would have made maybe 6 to 7% from that particular trade opportunity. But overall, it was a good trading opportunity. Let me show you the next one. But before that, let me announce our mentorship that is coming up next month, which is September. So our advanced smart money course will be coming up next month. This is actually the second batch of this mentorship, and if you're interested in joining the second batch of the mentorship, you can enroll from our website. When you visit our website at www.borntotrade.com, and you see this mentorship cost for $216, and this is actually the discount price. After now, it's going to go back to original price, which is $320. And this is what you're going to get from our mentorship. You're going to have access to our advanced smart money course. You're going to be part of our weekly chart breakdown. You're going to be part of our VIP support community. You're going to be part of our premium possible trade opportunities, and you're going to be part of our weekly Zoom meeting. And if you want to read more about the mentorship, you can actually click on see more to read more about this particular mentorship. Now, these are some of the reviews from our free mentorship. This is actually a free mentorship. These are the reviews, and if you want to read the review from those who enrolled for our VIP, so we have some reviews from those who are part of our VIP. We have some reviews from them, so you can actually check that out. Now, if you have any question or you want to communicate to me directly, you can do that via this particular link right here. Let's see the second example of today's lesson. So this is the second example I'm going to use for today's lesson. You can see I already marked them up. So the video is already taking a lot of time. I'm going to rush this particular one so you have a better understanding. This particular one was also shared to our VIP community. Now, what I said you should understand is the concept of what inducement and price imbalance. Now, looking at this particular area right here, you can clearly see that price moved with momentum to the upside. I hope you can see that. You see how price moved with a lot of momentum to the upside, and a lot of traders, when they come to select these points of interest, a lot of people might be paying attention to this particular range created demand level. But this demand level is actually an inducement area. It's an inducement area and it's not the right zone to trade from. Okay, this is not the right point of interest to trade from. Now, let's do the markups so you understand what price is actually doing. Now, how price imbalance is created is when price usually go to sweep the liquidity on the net lows. Now, what you're going to notice at this particular area is that the institutions came to take the liquidity at this particular low. You see how they reacted with momentum to the downside. Their only aim is to make sure that they're going to sweep the liquidity at this particular low. Now, after the sweep of this liquidity, you see how they reacted with momentum to the upside. They reacted massively to the upside. Now they had to range a little before pumping in a lot of money into the markets, and you see that massive reaction to the upside once again. Now, if you understand the concept of inducement, you're going to understand that this is actually a smart money trap. This particular one is actually very obvious because this is a liquidity area. You can see this looks like a trend line liquidity area. Is a trend line liquidity, and if you're looking to trade from this particular level, you're actually making a lot of mistake. This is not the best place to trade. Yeah, you understand that when momentum kicks into the market, when we see a range and momentum kicks into the market, here we understand that we have an order block right there. But in this case, when you understand that liquidity is resting at that level, you're going to avoid trading from there. And another confluence we have is the fact that we have price inefficiency underneath this particular level. Now, having in mind that price will always reverse to rebalance that inefficiency, and this is the correct zone to trade from because price will definitely come back to respect this particular level. Price is likely going to sweep the liquidity at this level, then coming back to rebalance or retest this particular level. And you see how price comes back, retest the level, and price is going to move away to the upside. This is actually the result right here because I and my team, those who are part of our VIP, they were able to get involved in this particular setup. So let me show you. So this is the results right here. This is price already offered about 2 hours on this setup, and it's currently just 30 pips away from our take profit. So I was telling them to move their stop loss at break even at this particular area, and the thing is that price finally hit our target. So it was at this particular area that price hit our take profit. Okay, we actually got involved, and as always, I secured 4 hours at this particular area. Have the general understanding of liquidity and inducement areas in the markets. So I hope this lesson makes sense to you. So all you have to do is to practice, and one thing you have to understand is that this particular setup I use right now is slightly different from the one I used for the first example. But once you have the understanding of liquidity and inducement areas, not only understanding this concept but having experience in the market, because all these are almost the same, just that price and different charts print it in different ways. Okay, I hope this makes sense to you. So if you really enjoyed this lesson, you can drop a like on the lesson, and you can look to subscribe to the channel for more contents like this. And if you want to enroll for our advanced smart money course, which is the mentorship coming up next month, which is September, you can look to visit our website at www.borntotrade.com. So in that mentorship, you're going to have access to our advanced smart money course, just like I said. I hope this lesson makes sense to you, and as always, once I'm done with my lessons, I always tell you to go back to the price charts and backtest, okay? Backtest and practice, because that's the only way you can actually improve. So thanks very much for watching this particular lesson. This is Tumi Solomon Wisdom, aka Born to Trade. And once again, thanks for watching this lesson. See you in the next lesson.